Yeah.
Spectacular.
Today is a special day. Of course, it was not today, but it was a bit later. The new Ferrari is out. I don't know if you guys really like cars like we do, but we thought, oh, maybe it would be a good thing to actually check out the new car. So Ferrari F80 is out, but also we thought like, oh, maybe it's actually good to see if Ferrari is actually publicly traded or not, and maybe figure out if we can look into the financials, because we actually check Tesla a lot, because well, it's all there, the hype is all there all the time and stuff like that. But we thought, maybe the real car company, we can have a look at those, and Ferrari is actually a very good one, huh? So shall we get to it, huh?
Yes, let's get into it. So, as you are used from us by now, we have a four-step process. So first we'll cover what's in the news. Then we'll go over the fundamentals of Ferrari. We'll go over their key financial ratios and key financial position. And finally, the value that you're going to get out of this video is, of course, a valuation of Ferrari. But that will be the beginning of your due diligence. As always, it's not financial advice. Do your own homework before you buy any stock. And yeah, with that said, let's get into it.
Yeah, sir. So basically, rule number one, as always, right? So we pop up Ferrari, which has a very funny ticker symbol. It's called race, right? It's you can definitely say they really like their racing cars. And what we see, huh? So first of all, very interesting for a car company is that the gross margins and even operating margins are very good. Very good, as well as the return on investment capital. So it means that, again, the aspect of having a luxury brand with the premium product, they can bump up the margins for the cars, of course, which is always nice. So the only question would be is just if the demand is there.
Exactly, but let's start with our 930 score for this one.
Yes. What do you see there?
So, of course, a B. So it's giving good signals when it comes to health. Like we saw that, like you just said, with the gross margins and operating margins. So that's all good. So if you click on the B, please, then we can dive into it deeper. So what's off here? We discussed. We've of course checked this a bit before we started filming, but the PE ratio isn't really there yet. I mean, on a negative side, right?
It's on a higher side. Yeah, that's
exactly
the thing. Yeah.
So it is scored a D. So here it says that the PE ratio is a 44.25.
We can see. So the PE part is indeed the D score, and the stock price change, which is nice. So the actual market is appreciating the stock itself quite nicely. So it's B. So the troubles are also lying within the growth prospect. So for example, the free cash flow growth is a little bit iffy. So it's more or less on the par with the market growth, right? But the margins are great, and the return on investment capital is also great. So it's good to see.
Exactly. And for example, I'm just quickly looking for other car companies, but I see that the Tesla has, of course, a higher PE ratio than Ferrari. But I'm just checking to see like how insane is the value, like the PE ratio that, or at least the price to earnings ratio that people are actually willing to pay for the stock.
Yeah.
Or like for the car industry in general.
Yeah. So Tesla is, I already checked, it's 64. So it's
64.
even more expensive than Ferrari, while you're getting way worse results in terms of the return on investment capital and as well as the margins, both gross and operating margin.
Exactly. Yeah, so that's something to consider, right? And we also have Volkswagen, and that's trading at 3, it says, but I'm not sure if that's the correct company
we can
here.
check Ford as well. Yeah, because Volkswagen has a little bit of a strange corporate structure, so Ford would be easier one. But yeah, you see, for example, Ford is a completely different caliber of cars, right?
Yep.
PE of 11, and then the gross margins, operating margins are super slim, so it's very different.
Yeah, so what we can say, it's looking in general, it's quite a high PE for any given company, right? So it might already give an indication of what this video will entail, but of course we go into it open-minded and just check what it's all about. So company foundations. Before we dive into it, if you like what you see with the app, for example, then feel free to go to the link in the description and get a subscription for yourself. And of course, if you like the value that you're getting out of this video, please consider subscribing. But yeah, so company foundations. So here we can see the average revenue growth checks. Everything is checked, right? So
Yep.
their long-term debts covered by free cash flow, good. Net income growth, share buybacks, free cash flow, dividend growth, everything's super nice. Given the one issue that I have, not issue, but it's quite recently listed on the stock exchange, like 2016. So
Mhm.
that's 8 years ago.
Yep.
No, yeah, 8 years ago. Yeah, so you don't really have a lot of backlog on this company, right? You don't have a lot of information to go on, but that's some part of the risk that you have to take. It can also, of course, be very lucrative.
Yeah, let's put it like that. So, from the perspective of the brand itself and its history, it's very extensive. It's very famous, especially in its racing departments and what kind of caliber of the cars they're making, right? The only question is, of course, the financials. Yeah, because you can love the product, but product or service that the company offers does not necessarily correlate with its stock performance. So this is also something for you guys to keep in mind. You may love the product, but you may hate the stock. So be careful with that.
Yeah, that's true. And also, it's a different kind of cookie when it comes to like we can look into it, but basically what Ferrari is doing is they have a couple of different approaches to selling. So normally, for example, with McLaren, their approach is like if you like the car, you can come in and buy it. But with Ferrari, if you want to buy, for example, LaFerrari or probably new F80 as well, you go into a dealership and they never seen you before, and they be like, no, 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 no. No, no, no. You first drive this California for a couple of years, buy another car, go to our races, and maybe then we'll give you the car. And then also what they do is, I'm not sure if this is still their business model, but back in the day they used to sell their cars to fund their racing operation. So yeah, there's a bit to uncover here, and I think we can look into it now. So let's go into the key financial results and also the key ratios, Kirill.
Yep, absolutely. So what can we see here? So growth is actually steady, surprisingly enough, right? So you don't see any big spikes or any changes. So what you mentioned is demand is there. So they make that limited supply, which still keep on driving the demand and interest from the customers, which is good to see. And that also means probably that they are at least not making worse products. So it means that the quality is still on par and it's been consistent at least over this past 8 years when it gets to the financial results.
Yeah. I also see that the long-term debt is steadily decreasing after 2021. So good signals there. I was also looking at the shares outstanding. There are no major spikes. It's just constantly going down, which is of course good to see.
Yep.
Yeah.
R&D is surprisingly also not that big, which I would be surprised actually from the car company, which is striving for innovation all the time. And of course, if you're also talking about, for example, the Formula One company, that requires a lot of efforts from the R&D perspective to be ahead of competition. So
Yeah.
that's pretty interesting. But looking healthy so far, healthy,
Exactly.
steady, without any complications or question marks, I would say.
All right. Shall we dive into the key ratios and check out the net earnings, for example? So here we can see positives. So for the last 2 years, they have been performing above the 20% threshold that we like to use. So they're performing 20% above the net earnings ratio, which is really good to see. So they're quite profitable and they're able to sell their cars for good margin. Of course, we've already seen this, but still nice to see that it also translates to their net earnings. Their research and development ratio is on the high side of things.
Yeah.
It is decreasing though, which is good to see. The average of 34%.
It's going down to 29 over the past year, but again, probably because of what I mentioned earlier, is that you still need to strive for innovation, make the cars better. You
Yep.
still have to spend a buck. So it's not something that, you can keep on manufacturing the same kind of a car for the upcoming 10, 20 years. You have to always make custom solutions, make improvements, and that's not ending ever.
Yeah. And then for the selling and general expense ratio, it's not as lucrative as I thought it would be, given, of course, that you're trying to target a very exclusive and small target audience. Mostly that comes with a price, but they are quite efficient with that as well. So they are now getting closer to the 20% mark, which is of course really nice. But then again, it's a really strong brand. I think everyone in this world knows what Ferrari is to a certain extent. So they have that going for them. Of course, they have insane brand value, and that's what you're seeing here. That's one of their modes.
Yeah, exactly. Yeah. I think what's worth talking about is again what we mentioned in the beginning about the growth prospects, right? We could see a big inconsistency, I would say, spikes all over the place. Sometimes it can go bamboozling high up. Sometimes it's going down, and there's no direct predictability here. So I would say, for example, with the free cash flow growth of 38% over the past 8 years, that's a bit of a stretch. So because of the very big outlier in 2019. So again, you see, for example, that's great benefit of using the 930 tool. You could see where the outliers are, and that will also help you shape your decision making. So for instance, you can ask yourself a question like, what actually happened in 2019? Why did it double? And then you can just base your due diligence further on that, and then use it for your assumptions in the future.
Yeah. And then I was also looking into their so adding to this, right? I was looking into their share buybacks because we normally say it's okay if they buy back their shares, it's really good, but it's also a matter of when they are buying back their shares.
Mm-hmm.
And we can see that the biggest changes are actually occurring in 2019 and 2020 around COVID. So looking at the graph, it didn't dip as hard as, for example, other companies did in the same period, but maybe they saw that the company wasn't growing, the stock price wasn't maybe as growing as much as the company financials, you know, had as a base. So maybe they could, choose to buy back their shares because they thought it was a good value for money.
Yeah, could be. And it's also not that they bought back a lot, because also probably if we'll check the P/E ratio from back in the days, it could be maybe a little bit too expensive.
Mhm.
So I'd also say, on contrary, it's actually good if a company doesn't decide to buy back its shares if they're expensive. So
Mhm.
what's the purpose of buying an overvalued stock again if it doesn't bring any added value? So you cannot actually make money on it if you wanna do something about it later on. So I would even say on this hand, this is good. But most likely you're also correct that there was a dip in 2019. We can also check it real quick, by the way.
Yeah, that wasn't really a dip per se, but maybe
Yeah.
it wasn't, like I said, increasing as much as their growth.
Yeah, because if we're talking about COVID was in 2019, right? I
Mm-hmm.
already don't remember anymore.
No.
Luckily. But yeah, there was a bit of a dip from the February to March
Yeah.
of about, we're talking about, let's say, 40 bucks, no, 25 bucks per share. It was a bit of a dip, but it's not radical. It's not like, for example, the airline stocks that happened,
Yeah, yeah.
back in the day. So that's good. That's also good to see.
All right. Is
Yep.
there anything else you want to cover, or shall we jump into the valuation?
I think that's pretty much it. So just as a wrap up, let's say, the company is offering a great product, right? Because of the fact that also the demand is there, and hence they can also keep very healthy margins, especially for a car company. The only question is, of course, is the growth prospects, because it's also a limited number of potential buyers who will be able to afford such luxurious cars. So that's also something for you guys to keep in mind for the future.
Yeah. And this you can also predict, right? There are numbers of how many millionaires and how much it's growing over time. Let's say that pool of target audience, and then you can also use that maybe as a prediction of like, okay, if they are expecting the number of millionaires to increase or decrease, then you can also maybe equate that to Ferrari. But then again, there are also collectors that are just rich as people who are just buying a bulk of cars, maybe not from the Ferrari directly, but all these things that you need to look into. So that's why we're always saying, like, don't just uh, take our value for it or evaluation for it. Just also do your homework. Like, why are these things happening, and why is it interesting to look further into it?
Yep, that's a very solid
Um,
point. Yep, fully agree.
all right, so let's go into the valuation, and here we go. So if this is the first time that you're watching this video, we'll go through our valuation process with you. But at the first stage, you can select on how long, or at least for what periods your assumption should should matter. So, for example, 3, 5, or 8 years in this case. So yeah, basically, the more data you have, the more accurate the picture is becoming. But if things are changing rapidly, then you might also, of course, want to, uh, take 3 years because it's closer to the current state of affairs. So either way, I see that, for example, average revenue growth for the past 3 years has been 11.8, 16, and 9. So I think using the 11.8 is actually quite on average
Yeah.
currently. So I think for the estimated growth rate, we can put something like 11 or 12. Let me just quickly check the analyst. If
Yeah.
you go to Yahoo Finance and go to analysis, you will find what the analysts think the share price will do in the coming years. And you can also use the average of our other metrics to come to a more precise number, let's say. Because what I'm seeing now is they say that for the next 5 years per year, Ferrari is going to grow with 18.6%.
Hmm.
So that's quite on the high side, right?
Yeah.
And I would say that's a bit too far fetched. There's a lot of uncertainty. And one of the first things people cut when things are dipping is luxury items. Then again, people who have the money to buy a Ferrari are different in a different ball game, right? Because they probably have real estate or businesses that flourish during these periods. But still, keep that in mind that 18.6%, I think it's a stretch. What do you think, Rio? What should we do for the estimated growth rate?
Yeah, good point. Because also, what you should also have a look at is that the free cash flow growth, and this one is also way bigger than the revenue growth. So it means maybe the analyst on Yahoo Finance kind of get something of an average between the two, more or less. So that's why they got a bit of a higher side from what their usual revenue growth is. I would say I would kind of agree with you. Let's say even 11-12% a year
Mm-hmm.
with a starting point of 1.4 billion. So that was the last year's free cash flow growth, free cash flow starting point. That would
Yep.
be very good, especially if also really depending on the projection period. So if we're talking about the 15 years, and if we're consistently for the upcoming 15 years, they would be delivering the 12%
Yep.
growth rate, would be very happy, I think.
Yep.
If we're talking about the smaller number of years, about 5, maybe you could make it a little bit bigger. But then again, you gotta have probably a better understanding why it's 18. Why is it not, let's say, the average for the past 3
Yep.
years? So there's got to be something coming in the pipeline, or they expect something that's gonna boost the revenue for the cars, or for maybe some additional services, let's say. So it's very questionable. And for example, I'm not a professional in the car business, let's say, especially in the luxurious ones. So I would be probably maybe a little bit more conservative in this case. But for example, I would be willing to put a higher projection period, because Ferrari is such a big brand that it would be very hard for it to probably go bankrupt unless something fundamentally wrong is going to happen to the company.
Yeah. And of course, we can also see, for example, like it has been founded in 1929. So it also has shown that it's resilient enough to go through a world war, to multiple recessions. So yeah, I think that's fair. I think that's a fair point. So yeah, then let's do the projection period for 15 years, just for the sake of your hypothesis. For the projected PE ratio, what would you say we put in there? So I see for the average for the past year was 42, but it's really on the high side, and of course now it's getting more crazy. I think even putting 40, like just imagine that Ferrari is able to keep a PE ratio of 40 consistently for the next 15 years. I think it's quite a stretch.
I would say depends on the economic environment that is ahead of us, and like if the fundamentals of the company are not going to be wrong. What you also mentioned, which is absolutely correct, if we, for example, check the number of the multimillionaires and the billionaires appearing in the world, you can also say they would be willing to pay the premium no matter what, because it's a brand, right? Then you could also maybe justify the premium in the P, because it's similar to, for example, the caliber of companies like Microsoft, like Nvidia. Nowadays, it is pretty much more than a double of a P you would be paying, let's say, I don't know, 30 years ago. But I
Yeah.
guess that's also the market we have to work with at the moment, is that there's very constant, quick, and high changes in the stock prices, and the valuations are also going through the roof for some reasons. So this is probably also a little bit of a new normal that's happening now, and I would say, yeah, 40 is too high, but again, this is high for a value investor, but for the regular market, it's probably going to be okay.
Yep. All right. So what do you say?
Let's start with 40, and then we can play around and see how the valuation turns out.
All right. Okay. So for the required rate of return, again, the S&P is returning between 7 and 10%, but you're stock picking, so you're having a bit much more risk. How much do you think Ferrari will keep on returning? Would you say it's fair to put it at like S&P growth rates, so 11-12% for the next year?
Yeah, I would say if we check again our 930 score, right? If we're talking about the stock price change year over year, it is on the B, so it's a little bit better than the average market performance, right? So we could say 11% would be good to get, let's say, from the expectations wise from the past years, at least from my perspective.
Yeah. And then the discount rate we normally keep at 10%, and for the margin of safety, for me personally, I will put this at a higher entry point because I am familiar with the brand. I am kind of familiar with how they operate, like how they manage their demand, but I'm not really 100% sure how, for example, the racing fits into their whole business model, how the cost structure is, for example. So I would need to dive a bit more deeper into more specific components. I would say maybe 30-40% ish.
Yeah, to be honest, I would agree. I would very much agree because this is not an essential product. Very luxurious, very something that you don't need to survive, let's say, and it's probably gonna be boosted when there's good economic times. So 30% for me is also justifiable, and additionally, I'm not professional in the car business, especially from the operational standpoint, so cannot really justify the lower margin of safety in this case. And
Right.
the last thing, estimated growth rate. So what do you think? So what shall we put in there?
We didn't cover that yet. So they said like 18.6%.
Mm-hmm.
The analysts say that it's going to grow at 80.6%, and then that's the, like you said, the average between the revenue growth and basically the free cash flow growth. They have been growing almost 10% over the past 8 years on average. And if you look at a shorter range, it's 11.8% for the past 3 years. I would give him, if we give him like 10%, I think that's fair if you look at the maximum range, right? So there's going to be fluctuations in between.
No. Yeah, I think let's try that. Let's try with that, and then we can again see. Yeah.
All right, and then press the analyst button.
What's gonna happen? Oh, okay. I'm actually pretty surprised, to be honest.
Yeah, it's not that bad.
Yeah.
So you would pay a bit of a premium if you would only consider the valuation.
Yeah.
So if you had like so you see the target buy price, but if you would, for example, have a margin of safety of 0, then you could make the case, okay, I'm gonna pay a $10 premium, for the brand. But then again, you can do this when you are really certain like what you're doing in terms of industry, in terms of like financials and their different revenue streams. So that's the key takeaway for this video, I guess.
Yeah, I would also say you can clearly see that the outlier is the target valuation formula, right? So again, it's really because of the fact that the prime drivers of it is EPS, future PE, which is already quite high, right? And then based on the growth rate and the number of years we're projecting for. So in this case, of course, the formula is gonna provide way bigger estimation in comparison even to the discounted cash flow formula that is usually like the benchmark for it. So yeah, you see, again, another great point. Is this outlier justifiable? Because if you remove it, then easily the target valuation would be around no more than $150, for instance.
Yep.
On the other hand, we can what we also mentioned, all the stocks nowadays are trading with very high PEs. It's pretty normal nowadays. Are you willing to pay that premium for a premium car company as well? Another question. So, we'll really leave it up to you guys.
Exactly. All right, Kirill. And with that said, where can we find the web app?
I can tell you, of course. So you would guys go to 930.com. A link would be in the description, as always. Here you can see the brief overview of everything what we just discussed so far. If you like it and you don't want to pay anything, just want to test it out, you can just get the free version. No credit card details involved or whatsoever. If you want just to use a valuation tool, we got you covered as well. No problem. You can just pay $15 and you're good to go without any monthly subscriptions or whatsoever. If you want more, if you want our upcoming screener tool, if you want to have access to the 950 score, if you want to get access to more upcoming features, then you can get a subscription. But then you can check, oh wait, it's only $3 per month or $30 per year. It's a grab. Just go get it. It's definitely way cheaper than your average other valuation tools that are out there on the market. But we got it covered. We got everything covered for way less than that because we're not crooks.
And as you can see, like most of the companies are in here. More than 35,000 companies are available on our valuation platform, covering, of course, from Milan to Amsterdam, New York, and anything in between. And plus that you saw how fast we are able to evaluate a company, so how fast you can go through this process, and that's really going to speed up your due diligence process. And I think with that said, Kirill, thank you for your lovely insights. Thank you for watching, and we'll see you guys in the next video.